Is rolling OPEX still a thing? What do you mean? Is that a concern for covered calls? Not really. I'm not sure what you mean, though. Maybe be a little more specific. Fubo's killing it. I'm thinking about buying more shares just to sell covered calls if the price goes higher. Not a terrible idea. There's always more opportunities in the market. Every day is a new day. There's always a new stock. There's always something that's gonna run. There's always something that's gonna drop. Just because you missed one thing doesn't mean you'll miss the next one. It's not a big deal. Like HKD is moving up today. I don't give a shit at all. You'll always have a group of people that chase literally everything that's currently happening in the market, and they never make any money. They're always up and then massively down and then up again and massive. It's like Wall Street bets, right? Stock groupies, kind of, yeah. They're the same people that like follow like bullshit speculation on Twitter every day, or only look at stocks after they're already up 20%. Your taste in food and movies is questionable, but you should know that I just installed a bidet and it's changed my life. Thank you, Pickle Man, for saving our butts. No problem, OG. Congratulations, by the way. How do you locate opportunities before researching them further? That's something you need to learn for yourself. Same people who follow Zero Hedge? Probably. You see them in here. They're always like, hey, look at this penny stock. It's up 200%. No one fucking cares, man. I hope you owned a shitload of it at the bottom, but you didn't, right? You're buying it because it's up 200%, so you're the dumb money. Even if you make money, you're still the dumb money in that scenario. Someone else is making more money than you. Spy what doing? Failing to hold the 39.50 resistance and simultaneously printing my 39.40 put strangle, which is chef's kiss. That was one time with Spurt. You know what sucks about getting in on this stuff early, like Fubo or BBBY or Spurt was a great example. Like these were all plays that I was super fucking early to. People are up like $1 and they sell. Like they have no constitution for holding with gains, right? Like they'll hold their losses longer. Like bag holders from the BBBY run, they will hold that shit into the fucking dirt, right? But they wouldn't sell at 5x their initial buy-in. And then like people who buy in early are up like 1x and they're like, I'm out. That's it. And then they buy back in as the price rises. Then they turn into the second person. That's the problem with the buy and hold strategy. They never figured out what to do next. So like this was like a lot of people's BBBY timeline, and I'm sorry if you're feeling very attacked right now. That's not my intention. But BBBY dropped and a bunch of people bought here between like $6 and $4. That's a weird way to write that. And then it started going up, and then it hit like 10 and a shitload of people sold. Then it hit 20 and they all bought back in again. And now they're holding. What the fuck? Like if you bought it $6, just like you can hold through 10. Like what's the fear there that it's going to go back to $6? Oh no. I can pretty much prove that you did this. Worse yet, some people bought here. Or here. But like every time I've done that, like Spurt went from like $5 to $50. Everyone sold at like 7. And then bought back at 40 and then held through the rest of the squeeze. Fubo, people are buying in at 3 and 4 and they're like, I'm out at 5. And then when it hits 10, they're going to buy back in again. It'll hit 12 and then drop back to 4. No, rule 1s don't lose money. Rule 2s don't chase. I think it's people don't have an understanding of the valuation of the thing they're buying. I really think that's a big reason. And that's why I tell people to read, Graham's books, because that gives you an idea of how to evaluate what you're holding. When I'm pointing these things out when they're low and then they go up, it's because their value is incorrectly being realized by the market. They are worth more than the current price. So the price you're paying is less than the value of the thing you're buying. And you're waiting for the market to realize the value of the thing that you bought for less, which will increase its price, right? But if you don't have an understanding of that mechanic, you're going to constantly fall into that trap. As someone who has no idea how to value a company, but beyond a relative comparison of incomplete data, I am your theoretical example. You say Chase squeezes, it's free money, but everyone who does that is broke, and then they spend the next 6 months making up fantasy stories about their stock and how they're sticking it to the hedgies because they need to find a social cause to justify their losses. You said no more Findom, yet here we are. Sorry. People always break apart traders and investors. So you have investors over here and they act all haughty, like, oh, I stick my money in things and let it grow. And you have traders over here who are like, I'm going to YOLO into that thing that guy tweeted about, right? And really, the most profitable person is in between, right? They understand valuation, but they also understand market inefficiency. And that's what I'm trying to teach you guys to be, is well balanced. Because this person makes the most money. This is the bury, right? They know when to get in, they know when to get out. They don't hold Microsoft for 10 years because they bought in too high, or like during the .com bubble. And they don't hold BBBY for fucking months because they got burned on a shitty position. But to be good at this psychologically, you need to be cynical. You need to be, when you see people like something, your initial reaction needs to be to hate it until it can prove otherwise. You should hit every potential investment with as much negativity as you feasibly can. And if it still seems good, it's probably worth buying. No, we're not calling ourselves transvestors, okay? I don't even think that's appropriate. Sus until proven bussin'. Exactly. Why do you think V is struggling a bit relative to the indices? Because the indices are struggling a little bit today. SPX is down 0.3%. V is down 0.59%. It fell below 200. It's dropping with the market. It's hitting its pre-market lows, which it hit earlier. Look for recovery and then play the crossover point to the upside. V is not very complicated. It's an easy stock to play. Market's down, V down. Market's up, V up. Usually earnings up, V up. Jesus Christ. I'm taking a minute.